The committee deliberated and assessed global and domestic macroeconomic developments for the first 4 months of the year and the balance of risks to the outlook. A summary of the assessments and key considerations that informed the committee's decision on the positioning of the monetary policy rate is as follows. Global economic activity remains resilient despite sustained monetary policy tightening across advanced economies and emerging market and developing economies. The global growth outturn of 3.2% in 2023 largely reflected stronger consumption spending due to employment growth, particularly in advanced economies, and policy support in China, US, and some larger emerging market and developing economies. Other factors that further supported global activity in 2023 were addition to the stock of capital, a rebound in the manufacturing and services sector, improved trade, and the resolution of pandemic-era supply chain disruptions. In the outlook, IMF growth projections point to global growth remaining resilient at 3.2% in 2024 and 2025. Downside risks to the growth outlook include the observed slowdown in the disinflation process since early 2024, geopolitical uncertainty, and elevated debt burdens. Global headline inflation remains above target in most countries. Progress towards inflation targets has somewhat stalled since the beginning of the year due to a resurgence in crude oil prices as OPEC Plus slashed production and increasing prices in the services sector. This notwithstanding, inflation is projected to decline steadily on the back of tighter monetary policy, softening labor market conditions, and fading effects of past shocks. Central banks have remained cautious in lowering policy rates due to the sluggishness of the disinflation process. Policy rates have been kept elevated to anchor inflation expectations and further drive down long-term inflation rates. Consequently, global financial conditions have generally remained restrictive. Longer-term bond yields have also risen due to the expectation of maintenance of a still tight policy stance in the near term. In the outlook, financial conditions are expected to ease in 2024 as the disinflation process continues and oil prices decline amid well-anchored inflation expectations. In the domestic economy, high-frequency real sector indicators point to a sustained pickup in economic activity through the first quarter of 2024. The updated Real Composite Index of Economic Activity recorded an annual growth of 2.1% in March 2024, compared to a contraction of 6.4% in the corresponding period of 2023. The pickup in the index was driven mainly by increased imports, private sector contributions to Social Security, and tourist arrivals. Ghana's Purchasing Managers Index signaled an improvement in business activity as the index rose to 51.3 in April 2024 from 50.9 in March due to improved consumer demand. The latest confidence surveys conducted in April 2024 point to a softening of sentiments. Both business and consumer confidence dipped. On the part of consumers, these sentiments were on account of uncertainties about future economic conditions, while businesses expressed concern that the recent exchange rate volatility and unstable intermittent power supply situation could significantly raise their operational costs going forward. The disinflation process remained sluggish over the first quarter of the year. Inflation, which declined to 23.1% in December 2023, moved up to 25.8% by the end of the first quarter of 2024. This slowdown in the disinflation process was driven in large part by rising food inflation, mainly seasonal food crop items. In April, however, inflation eased to 25% on account of improvements in the supply of seasonal food crops, which seems to have been countered somewhat by increasing non-food inflation from the exchange rate pass-through effects. Food inflation declined to 26.8% in April 2024 from the high of 29.6% recorded in March 2024, while non-food inflation increased to 23.5% from 22.6% over the same comparative period. Notwithstanding the sluggishness of the disinflation process, underlying inflationary pressures are well contained. All the core measures of inflation monitored by the bank continue to ease. Isolating price increases of energy and utility items from the consumer basket, core inflation moderated to 24.8% in April 2024 from 26.3% in March. Fiscal performance is broadly in line with targets agreed under the International Monetary Fund supported program. Provisional data on the execution of the budget shows that the primary balance on commitment basis was a deficit of 0.6% compared with a target deficit of 0.2%. The overall broad budget balance on commitment basis was a deficit of 1.8% of GDP compared with a deficit target of 1.7% of GDP. Total revenue and grants for the period amounted to 30.4 billion Ghana cedis compared with a programmed target of 37.7 billion Ghana cedis. Total expenditures on commitment basis for the period amounted to 49 billion Ghana cedis compared with a target of 55.5 billion Ghana cedis. Growth in monetary aggregates slowed down considerably, reflecting the bank's liquidity management operations to tighten liquidity. Total liquidity M2 Plus grew by 29.9% in April 2024 on a year-on-year basis, compared with a growth of 45.6% in April 2023. The relatively lower growth in M2 Plus was reflected in all its components, namely currency with the public, demand deposits, savings and time deposits, and foreign currency deposits. Commercial bank reserves with the central bank surged following the implementation of the dynamic cash reserve requirement. As at the end of April 2024, reserve money growth on a year-on-year basis had increased to 51.9%, mainly due to the changes in regulatory reserves relative to a growth of 46.5% in April 2023. Growth in private sector credit continued to remain weak. Private sector credit slowed to 10.8% in April 2024 from 19.8% in April 2023. In real terms, credit to the private sector contracted by 11.4% relative to 15.2% contraction recorded over the same comparative period. Short-term interest rates on the money market broadly showed upward trends. The 91-day and 182-day Treasury bill rates increased to 25.68% and 28.03%, respectively, in April 2024 from 19.67% and 22.29%, respectively, in the corresponding period of 2023. The rate on the 364-day instrument increased to 28.64% in April 2024 from 27.04% in April 2023. The interbank weighted average rate remained within the policy corridor. The rate increased to 28.68% in April 2024 from 25.89% in April 2023. In contrast, the average lending rates of banks declined marginally to 31.25% in April 2024 from 31.66% recorded in the corresponding period of 2023. Banking sector indicators point to a recovery from the impact of the domestic debt exchange program. Total assets increased by 28.8% to 306.8 billion Ghana cedis at the end of April 2024, driven by domestic currency deposits and other funding sources. Banks also reported higher profits for the first 4 months of 2024 relative to the same comparative period in 2023. Key financial soundness indicators generally improved during the review period. The capital adequacy ratio adjusted for reliefs increased to 15.5% in April 2024 from 14.7% in April 2023, reflecting the rebound in profits. Capital adequacy ratio without relief for the banking system was 11.5% at the end of April 2024 compared to 7.6% in April 2023. Liquidity and efficiency indicators also improved in April 2024 compared to the same period last year. The non-performing loan ratio, on the other hand, increased to 25.7% in April 2024 from 18% in April 2023 due to the lagged effect of the COVID-19 pandemic and economic crisis of 2022, which has led to the downgrading of several large exposures of banks. The sector is expected to be strengthened as banks recapitalize and enforce stringent credit underwriting standards. On the international commodities markets, prices of Ghana's major exports, cocoa, gold, and crude oil, recorded gains in April 2024. Cocoa prices continue to increase, reaching $10,116.9 per ton in April 2024 from $4,235.6 per ton in December 2023. Representing a year-to-date gain of nearly 139%. Crude oil prices increased by 15.2% on a year-to-date basis to $89 per barrel in April, compared to $77.26 per barrel in December 2023. Gold prices also increased by 14.7% at the beginning of the year to $2,334.2 per fine ounce. The balance of trade recorded a lower surplus of $744.3 million for the first 4 months of the year compared to a surplus of $1.39 billion in the corresponding period of last year. Total exports increased by 4.9% to $5.83 billion, driven mainly by significant growth in gold exports and a modest increase in crude oil exports. Earnings from gold exports increased by 37% to $2.97 billion due to higher volumes of exports from small-scale gold production. The value of crude oil exports in comparison increased by 9.4% to $1.27 billion on the back of both volume and price increases. Exports of cocoa, both beans and products, dropped by 49% to $599.3 million. Other exports, including non-traditional exports, also decreased by 6% to $981.8 million. Total imports increased by 22.2% to $5.08 billion, driven mainly by non-oil imports, which went up by 31.2% to $3.5 billion, while oil imports increased by 5.6% to $1.55 billion. Provisional data for the first quarter of the year resulted in a current account surplus of $372.12 million. This represented a 40.8% decline from the surplus of $629 million recorded in the first quarter of 2023. The lower surplus was driven mainly by higher imports and increased income payments. Net income payment was $727 million for the first quarter of 2024 compared to net income payment of $508 million in 2023. Remittance inflows increased sharply to $1.44 billion compared with net inflows of $980 million over the same comparative period. The capital and financial account recorded a net outflow of $113 million, lower than the net outflow of $998.4 million recorded in the same period in 2023. The reduced capital outflows were largely driven by significant inflows from the IMF and the World Bank, as well as improved FDI flows to the economy. These developments resulted in an overall balance of payment surplus of $84.7 million in the first quarter of 2024, compared to a deficit of $586.9 million in the same period of 2023. Gross international reserves position remains strong. At the end of April 2024, the stock of gross international reserves increased to $6.59 billion, representing 3 months of import cover, compared with $5.91 billion, 2.7 months import cover at the end of December 2023. Gross international reserves, excluding encumbered and petroleum assets, also increased to $4.32 billion, compared with $3.66 billion at the end of December 2023. The exchange rate has recently come under some pressure, especially in the Forex Bureau market. The pressure in the market reflected increased demand for higher imports, energy sector payments, and uncertainty surrounding the progress of debt restructuring negotiations with external creditors. These conditions have fed into sentiments and contributed to additional pressures. On a year-to-date basis, the Ghana cedi depreciated by 14.6% against the US dollar as at the 22nd of May 2024, compared to 21.8% depreciation for the first 5 months of 2023. To sum up, global growth remains relatively strong, bolstered by an expansion of economic activity in large economies despite the tight monetary policy stance. For the year so far in 2024, progress towards attaining inflation targets globally has somewhat stalled as oil prices have risen due to escalating geopolitical tensions. For emerging markets and developing economies, the strengthening of the US dollar and the tight monetary policy stance of the US Fed have induced more headwinds to the disinflation process. Due to these developments, central banks have mostly been cautious to loosen their tight monetary policy stance. In the outlook, however, central banks are expected to start the easing cycle when inflation begins to steadily decline towards targets. The Bank of Ghana's high-frequency real sector indicators pointed to steady improvement in economic activity evidenced by continued steady growth in the CIEA. Similarly, the Purchasing Managers Index firmed up, driven by resilient consumer demand. On the contrary, real private sector credit remains generally weak, while business and consumer confidence softened, reflecting concerns about the high cost of raw materials and foreign exchange market pressures. Ghana's external sector position remains strong, although the current account surplus nearly halved in the first quarter of the year. Performance in the current account reflects a rebound in imports and net income payments. Accumulation of reserve buffers remains on course and set to exceed the program expectation in June, largely due to the domestic gold purchase program. The bank's reserve at 10 April 2024 currently stands at 3 months of import cover. The exchange rate pressures witnessed in recent weeks reflect a weakening of the current account surplus due to higher import demand, lower export revenue, especially a sharp fall in cocoa export earnings. Foreign exchange market pressures also reflect robust public spending on IPP arrears payment and capital expenditure outlays. There are also indications of increased pressures from importers diverting foreign exchange demand requirements into informal markets, increasing speculative demand for foreign exchange. The Bank of Ghana, however, has adequate reserves to manage these shocks to the foreign exchange market, having added over $600 million to the current foreign exchange reserve levels over the first 5 months of the year. The improved reserves position is also backed by strong liquid monetary gold holdings of over 26.6 tons, estimated at $2.1 billion, as a result of the very successful domestic gold purchase program. The Bank of Ghana remains fully committed to provide stability in the exchange rate for the cedi. The bank has enough foreign exchange reserves to support the market, and economic agents should stop engaging in speculative purchases, as they will suffer economic losses when the correction occurs. The Bank of Ghana is taking measures to improve market conduct and instill sanity in the market for foreign exchange. To this end, the bank has worked with the Ghana Association of Banks to streamline documentation requirements for foreign payments to minimize the incentives to resort to the informal markets. To deal with the high demand pressures on the foreign exchange market, the bank has taken steps in the past few weeks to directly absorb foreign exchange needs of some corporate institutions, and this has led to a reduced pipeline demand for foreign exchange from the commercial banks. The bank is fully aware of the operations of illegal operators in the foreign exchange market and is working with the Financial Intelligence Center to sanitize the market. Foreign Exchange Bureau monitoring will be stepped up to ensure compliance with their regulatory framework. In line with this, all foreign exchange bureaus advertising rates outside their premises and on social media platforms must immediately desist from the practice. The bank has set up a task force to monitor all the foreign exchange bureaus to ensure compliance. The foreign exchange market is also affected by sentiments and pronouncements made in this election year, and we urge all to manage pronouncements which weakens confidence in the local economy. On fiscal policies, expenditures outpaced revenue growth in the first quarter, reflecting the front-loading of IPP payments, arrears payments. Maintaining strict fiscal policy for the rest of the year will be crucial to strengthen confidence in the economy. On general macroeconomic conditions, the committee was of the view that while implementation of policies at the macro and structural reform level are consistent and align well with the tenets of the IMF-supported program, there is the need to ensure that the recent depreciation of the currency does not become embedded into the pricing behavior of businesses and on inflation expectations. The strong build-up of about $2 billion since the beginning of the IMF program, the strong disinflation process, the significant progress on fiscal policy consolidation, the positive current account balances, and the good progress on external debt restructuring process have all worked in concert to deliver enough buffers to support the exchange rate. The latest forecast shows a slightly elevated inflation profile on account of recent exchange rate pressures and adjustments in transportation fares. However, the projections show that inflation will remain within the monetary policy consultation clause of 13 to 17% at the end of the year. These forecasts are contingent on sustaining the tight monetary policy stance, including aggressive liquidity management operations. Given these considerations, the committee decided to maintain the monetary policy rate at 29%.